When we talk about the content empire that consistently produces hit dramas, the name ONEE, the One Enterprise, it's got to be right at the top, doesn't it?
Absolutely. They're a major player.
But in this era where streaming and online platforms are just eating up huge chunks of the advertising market, the big question is, will One's Q368 financials, can they really maintain that content king status and keep delivering profits?
That's the core question, isn't it? And it goes deeper.
Right, like this strategy of selling content licenses overseas and really pushing revenue from online platforms, is that the real key? Is it sustainable?
Well, that's what we're here to figure out. It's vital, I think, to look past just the traditional TV metrics here.
Okay.
Because, for anyone tracking media in Southeast Asia, ONEE's been this really fascinating case study in how a company transforms itself.
So today, we dive deep into ONEAZ. Hello, and welcome to the Deep Dive.
Yeah, our mission today is exactly that. Let's analyze the fundamental factors of ONEE. We'll use the latest data we have, which is Q32568. And just for context, that 2568, that's the Thai Buddhist calendar year we're referencing.
Good clarification.
And we're going to assess its resilience, as a content leader. But specifically, we want to chart its transition. How is it moving from being primarily a domestic broadcaster into something more like a sophisticated regional content provider?
Moving beyond just TV ratings.
Exactly. We need to understand the whole ecosystem they're building. It's much more diversified now.
Okay, let's unpack this then, starting right at the top. Q32568 performance. Before we get into all the strategic shifts, the market was expecting a decent quarter, but the headline numbers, they seem to deliver a pretty big surprise, didn't they? Especially given the broader economy.
Oh, it was more than strong. It was, frankly, a massive beat. It really sent some ripples through their analyst community. So total revenue, let's start there. It came in at 2007.08 million Thai baht. Now, on its own, that's a solid increase, almost 10% year on year, so plus 9.83% compared to Q3 last year.
Right.
And a pretty robust 12.17% jump sequentially from Q2. So good top-line growth.
But revenue growth isn't the whole story, is it? It's the profitability, the efficiency that really matters.
Exactly, and that brings us to the net profit. That's where the real fireworks were.
Okay, give us the numbers.
The net profit landed somewhere between, say, 203.8 million and 206 million baht. And look at the growth percentages here. Year on year, that's up somewhere between 22.3% and 26%. Solid.
Pretty good, yeah.
But the sequential jump quarter on quarter from Q2 was huge. Up 135% to 139%.
Wow, okay, so more than doubled from the previous quarter.
Yeah, effectively doubled the net profit in just 3 months, and that's why the analyst reaction was so strong.
I bet.
You had major houses like Krungsri, for instance, pointing out that this profit number just significantly blew past both their forecasts and the general market consensus.
How much higher?
They actually stated it was reportedly 4 to 5 times higher than what they had initially projected.
4 to 5 times? That's not just a beat, that's something else entirely.
Exactly. And when a company outperforms expectations that dramatically, it's a strong signal,
Yeah.
It suggests that these strategic shifts we're about to discuss, they're not just talk. They're translating into serious bottom line results.
Yeah.
It's not just a temporary volume blip.
Right, it points towards maybe a sustainable structural change. So what exactly drove this massive jump in profitability? To get that, we really need to look under the hood at the gross profit margin, the GPM.
Definitely. The reported GPM for Q3 was 37.6%.
And how did that compare to expectations?
Well, it was notably higher. Some brokers, for example, were expecting something more like 30.5%. So 37.6% was a positive surprise on the margin front, too.
Okay, so higher revenue and better margins than expected. What drove that GPM improvement, especially from Q2 to Q3?
Well, that sequential improvement, Q3 versus Q2, it really speaks directly to this concept of economies of scale.
Right, the idea that as you produce more, your fixed costs get spread thinner.
Precisely. Think about ONEE's business model. It's built around a pretty heavy fixed cost base, right? You've got studios, production facilities, big talent contracts, network operations, lots of costs that don't change much, whether they have one hit show or 10.
Okay.
So when their high-quality content really hits big and revenue jumps significantly like it did quarter on quarter, those fixed costs suddenly get spread across a much larger revenue base.
So each extra band of revenue costs less to generate.
Exactly. Every extra viewer they pull in, every extra license they sell overseas, a much higher percentage of that flows straight to the bottom line as pure profit because the main production cost was already sunk. ONEE clearly benefited massively from hitting a kind of critical mass with its content portfolio this quarter.
Okay, that makes perfect sense for the jump from Q2 to Q3, but here's where I want to play devil's advocate, or maybe the listener's skeptical voice here. Some analysts noted that while the GPM was great in Q3, it actually seemed to reduce slightly year over year. How does that square with becoming more profitable overall? Why would the structural margin profile soften a bit compared to last year?
That is a really critical point. It gets right to the heart of the shift in their entire business model.
Yeah.
It's about the mix of revenue.
Ah, the mix. Okay.
See, as you rightly noted, ONEE basically operates under two huge revenue umbrellas now: content marketing and idle marketing.
Content marketing being the more traditional TV advertising and domestic licensing.
Correct. And historically, that segment, content marketing, has carried the highest margin profile for them. It's very profitable when ad spend is strong.
And idle marketing, that's the artist management, concerts, merch.
Right. And that idle marketing segment, as we'll get into in detail, grew like crazy, just phenomenal growth.
Huh.
But structurally, it tends to have slightly lower gross margins than the pure advertising side.
Okay, I see where this is going. So the high margin content marketing part shrank a bit year over year.
Due to those headwinds we'll discuss.
Right. And the slightly lower margin, but incredibly fast growing idle marketing part took up a much bigger slice of the total revenue pie.
Exactly. So when you blend those two together, the overall blended GPM naturally compresses just a little bit compared to the previous year when advertising was perhaps a larger share.
So it's a trade-off. They sacrificed maybe a couple of points of pure GPM for massive volume growth and presumably more stability.
That's precisely. It's the cost of building resilience. This new mix gives up a tiny bit of peak margin potential, perhaps, but it delivers huge volume growth, and crucially, it insulates them better from external shocks. Which brings us directly to the volatility in that traditional content marketing business. It needed that cushion.
Yeah, let's talk about that segment because it clearly faced some serious headwinds in Q3. Content marketing revenue was 959.82 million P5. But as you mentioned, that figure showed a pretty sharp year-over-year decline, down 19.01%.
19% is a significant drop.
Analysts pointed to a couple of major reasons for this pullback in TV ad spending. One was just challenging macroeconomic conditions overall.
Which usually hits ad budgets first.
Right. And the other was more specific, geopolitical tensions, particularly mentioning issues near the Thai-Cambodia border.
Yeah, we should probably explain the link there for listeners. When analysts talk about challenging macroeconomic conditions, that usually means things like lower consumer confidence, maybe higher inflation or interest rates. And businesses react by cutting back on discretionary spending. Advertising is often, one of the first things on the chopping block.
Makes sense. But the geopolitical part, how does tension on the Thai-Cambodia border translate directly into a 19% drop in TV ad spend for ONEE?
It creates a cloud of uncertainty that can hang over the whole regional economy. It impacts things like cross-border trade, tourism, general business confidence in the region. So advertisers who cater specifically to those segments, or maybe just companies that feel nervous about regional stability in general, they tend to pause big spending commitments. And traditional linear TV advertising, well, that's often a big, easily adjustable commitment.
So when things feel uncertain, corporations hit the brakes on those big TV ad campaigns first, wait and see.
That's often the pattern. They pull back pretty quickly, waiting for more clarity. So understanding that macro context is really crucial for why that content marketing segment looked weaker year over year.
But, okay, despite those pretty severe external pressures, the segment still showed some maybe surprising resilience. You mentioned the content marketing revenue actually increased sequentially, quarter on quarter, by 1.74%. It's small, but it's positive growth from Q2. Where did that little bounce come from?
Yeah, it's small but significant. That sequential growth is basically the proof in the pudding that their strategic adjustments within that segment are starting to work, helping to stabilize the core business even with headwinds.
So how did they manage that?
It looks like it came from two main places. First, just the ongoing strength of their content. They continue to produce high-quality, high-rating dramas and shows that still attract those premium advertisers who are willing to pay top dollar for primetime slots, even in a tougher market.
Content is still king, even in advertising.
It really is. And second, critically, was the expansion onto online platforms. They're getting better at monetizing their content digitally within that content marketing umbrella. So they're capturing online ad revenue related to their shows, which helps offset some of the declines they're seeing in the traditional linear TV budgets.
Okay, so they're not just sitting back and watching traditional media decline. They're actively using the strength of their content, the fuel, really, to pivot how they monetize it, shifting more towards digital even within that traditional segment.
Exactly. That strategic flexibility is why the year-over-year decline, while significant, maybe feels less catastrophic than it might for a competitor who is purely reliant on old-school linear TV ad revenue.
They're using their own IP to drive engagement across different platforms, minimizing the damage from the volatile TV ad market. And that really sets the stage perfectly for the other side of the story.
Precisely. They're using content to manage the downside and setting the stage for the next segment we need to discuss, the incredibly successful counterpunch from idle marketing.
Right, Section 2, the idle marketing engine. If content marketing was sort of weathering the storm, idle marketing looks like it was the absolute growth champion for ONEE in Q368. It really seems to confirm the success of their diversification strategy.
Phenomenal growth is probably the right term here. Idle marketing revenue hit 996.62 million baht.
Almost a billion baht just from that segment.
Yeah. And just to put that in perspective, that's an increase of 66.59% compared to the same quarter last year. Huge jump. And even quarter on quarter from Q2, it was up a very strong 23.68%.
Wow.
So this single business segment, idle marketing, was really the primary force that offset the dip in content marketing revenue. It's why the overall company could deliver such a massive net profit beat.
It's clearly more than just, managing a few actors here and there. It sounds like they're building a really comprehensive, high-engagement fan economy. For the listener, can we break down the core components that are driving this huge success in idle marketing?
Yeah, absolutely. We can really break it down into three main areas. They're distinct, but also highly interdependent. They all leverage the same core pool of talent.
Okay, what's the first?
First is artist management. This is still the foundation, right? Handling the actual celebrity talent, the actors, the singers that come out of their shows. It involves managing their schedules, their appearances, negotiating contracts, endorsements, and just making sure their visibility stays high across all the different media channels.
Now, the source material we looked at mentioned a slight sequential decrease in artist management revenue specifically, comparing Q3 of 67 to Q2 of 67, even while the overall idol segment was booming. Does that suggest maybe there's a risk in relying too much on just individual star power?
That's a good catch. It does highlight the inherent sort of lumpiness or volatility you can get with talent-based income streams.
Right.
Artist management revenue can fluctuate based on, say, the timing of specific endorsement deals coming through, or maybe when major contracts are renewed, or even just the production schedule of a particular drama involving a key star. It doesn't necessarily mean the underlying business is weak.
Okay, so maybe just timing issues within that specific subsegment.
Probably. And the broader strength of the overall idol marketing segment is clear when you look at how they monetize that same talent through live events, which brings us neatly to the second component, concert and event organization.
The live experience. This seems to be booming everywhere. These big production houses are realizing, selling a TV show is one thing, but selling a direct live experience to the fan, that can be a massive profit multiplier.
Absolutely. And we saw really strong sequential growth here for ONEE. Concert and event revenue grew 10.47% just from Q2 to Q3.
That's driving that. Just more events, bigger events.
Both, it seems. It's driven by these large-scale, meticulously produced events that are designed to maximize fan engagement and, of course, ticket revenue. The sources highlighted some major successes just in Q3. Things like the Gemini 4th Run the World concert, the Golden Song, the Golden Show Concert 2024, something called the We Are Forever FanCon, and the Lee Can-en Unleashed concert.
These sound like big productions.
They are. These aren't just small club gigs. They're massive fan-driven spectacles, often in large arenas.
And what seems particularly striking about this event segment is the shift towards global reach. It's not just confined to the Thai domestic market anymore, is it? How significant is that international touring piece becoming for their business model?
It's absolutely critical. I'd say it's the strategic core that really elevates the margin potential of this whole idol marketing segment. One is actively, deliberately prioritizing international fan meets and concerts.
Wider margins overseas.
Potentially, yes. Margins on international events, especially if they're organized efficiently, can definitely be higher. But maybe more importantly, it just opens up entirely new massive pools of revenue from global fan bases.
And they were active internationally in Q3.
Very active. In Q3 alone, the sources mentioned events spanning Asia, Europe, and even South America. They had specific stops listed in places like Taiwan, Hong Kong, China, Vietnam, Japan, plus other key markets mentioned in Europe and South America. They are successfully exporting their talent and their, frankly, highly refined fan engagement model across the globe.
So they're basically taking the actors and singers who become famous from their Thai dramas and turning them into global lifestyle exports, leveraging the popularity that the content initially generated.
That's exactly the model. And it leads perfectly into the third component driving idol marketing success: merchandising.
Right, the merch. The classic high-margin retail side of any strong fan economy. T-shirts, posters, light sticks.
All of it. And it showed consistent, significant growth too, up 10.00% quarter-on-quarter in Q3. It makes sense, right? Fans who are engaged enough to fly to these global concerts, or who follow their idols intensely online, they become highly motivated consumers for official merchandise.
Especially the limited edition or commemorative stuff.
Exactly.
Right.
Commemorative items, branded goods, other licensed products. It creates this really nice circular economy. For one, high-quality content creates a fan base. The fan pays to see the idol live at a concert, and then the fan buys the official merch.
It's a beautifully vertically integrated revenue chain, all stemming from that initial content creation.
Totally. And that vertical integration, that diversification, is key to their whole risk mitigation strategy we talked about earlier. When you combine the power of this booming idol marketing segment with the growing content licensing revenue, which we'll detail next, their dependence on that volatile traditional advertising revenue starts to look relatively low.
Yeah, what's the number on that now? How much of their total revenue actually comes from traditional TV ads?
Analysts have pointed out that ONEE's dependence on traditional TV advertising revenue is now down to only about 34% of their total revenue.
Only 34%. That's surprisingly low for a company with roots so deep in broadcasting.
It is dramatically lower compared to many of its competitors, especially those who are still heavily reliant on the traditional volatile TV ad spend cycle. This diversification is their strategic firewall.
So the thinking is, if the Thai economy hits a rough patch and ad spending freezes up again, the company now has this robust, increasingly global idol engine, plus the international IP licensing income stream we're about to discuss, to cushion the blow and hopefully keep growth targets somewhat on track.
That's the strategy in a nutshell. Q3 really confirmed that this strategic pivot towards diversified lifestyle entertainment income streams is working. It's delivering stability. And critically, these newer streams, particularly the licensing, inherently carry higher GPM potential over the long run, especially when you factor in that idea of monetizing existing content assets globally, that potential revenue at minimal cost concept.
Which is our next big topic. Okay, let's transition now. We've seen how they're managing traditional revenue streams and building new ones like idol marketing. Now, how are they dealing with the huge, undeniable force of digital disruption? Streaming platforms like Netflix, Disney Plus, Prime Video, where they're supposedly the grim reapers for traditional media companies. Yet one seems to be finding ways not just to survive, but maybe even thrive alongside them.
Well, the industry risk is definitely real. You can't deny it. You've got high competition from all these online channels. You've got relatively low entry costs for new digital-first operators popping up, and there's maybe an overall slowdown in certain parts of the traditional media industry. It's a tough environment.
So what's ONEE's counter strategy? How do they compete?
Their countermeasure isn't really to fight the digital wave head-on. It's more about learning to ride it. And crucially, it's about owning the content that everybody wants to watch, regardless of which platform it ends up on.
Content is the currency.
Exactly. And they leverage that currency using two main tools: their own proprietary platform and their absolutely massive general social media presence. These are central to controlling their own destiny in the digital space.
Okay, let's try and quantify that scale. Their online footprint sounds enormous.
It is genuinely staggering. And this is where a significant competitive advantage lies, I think. Their total social media followers across all their various platforms and channels now exceed 200 million people globally. 200
million. That's the population of a very large country like Brazil or Nigeria, actively following ONEE's content ecosystem.
It's a massive, highly engaged global audience. And if you break down the components, the sources cited numbers like 96.17 million followers just on Facebook properties, another 89.69 million subscribers on YouTube channels, and nearly 26 million followers on TikTok.
Okay, 200 million followers. How does a company even manage, let alone leverage, an audience that large? And what does that scale mean when they're negotiating with, say, the big global OTT giants?
That scale gives them at least two enormous advantages. First, it's effectively a massive addressable audience that they can reach for basically zero marginal cost.
Right, they don't have to pay for reach.
Exactly. They effectively control the distribution channels and the conversation around their own content. These digital platforms become free, incredibly efficient marketing channels for their main TV shows, their idol business, everything. They don't have to hand over enormous sums to Meta or Google just to find their audience. The audience is already there, actively following them, waiting for the next piece of content.
Okay, that's a huge marketing advantage. What's the second advantage?
The second is that it means they're not entirely beholden to any single third-party platform for distribution or audience engagement. This is reinforced by their own proprietary platform, the ONEE application. That helps build a protective moat.
Ah, yes, the ONEE app. How is that performing? Is it actually getting traction?
Seems to be. The sources mentioned that the ONEE application successfully achieved status as a top 3 entertainment application in Thailand. It acts as a central hub for all their content dramas, variety shows, news, etc.
And as it drives viewership?
The historical data cited suggested it was driving significant growth. Figures like a 70% increase in downloads and a 39% increase in actual viewing time were mentioned from past reports. By keeping users engaged with their high-quality content within their own ecosystem, they increase that stickiness, they gather really valuable first-party viewer data, and they have a direct channel for monetization, whether that's through ads within the app or maybe even future subscription models.
But none of this digital strategy, none of the apps or follower accounts, none of it works without the core product, right? The root source of their strength still seems to be the consistent quality of their original content, generating those highly popular, high-rating shows that command viewer loyalty and advertiser interest.
Absolutely. Content quality is the engine that powers everything else we've discussed. And we saw clear evidence of that continuing success in Q3. The drama Mayua, for example, wasn't just a modest hit. It actually broke Channel 131's internal record for a highest premiere rating ever, hitting a 3.089.
That's a big number for a premiere.
It is. And they also produced other major high-profile hits that were generating buzz. Shows like Thong Braki Sang, Bangkok Kanika, and Songkram Samrat. These aren't just niche programs. They become part of the cultural conversation.
And these hip shows, these high-quality assets, are precisely what fuels the big strategic pivot we've been building towards, international content licensing. This seems like the ultimate execution of that regional content provider model.
This is where the magic of IP monetization really starts to shine. It perfectly embodies what we call that high-efficiency strategy, or the idea of potential revenue at minimal cost.
Explain that again. How does it work?
Okay, think of it like this. One pays to build the factory, the studios, hiring the actors, the whole production process. They pay for that once to create a piece of content like a drama series.
Right, the initial investment.
That factory generates the content. Now, once that content has aired domestically in Thailand, served its primary function of attracting viewers and advertisers there, the additional cost of selling the licensing rights to that same show to an overseas OTT platform or broadcaster in another country, it's virtually zero. The content already exists.
Okay, so the asset is created, the main domestic production cost is hopefully recovered through ads and local views, and then any international licensing income they get from that same asset is almost pure high-margin profit that flows directly to the bottom line, potentially for years to come.
Precisely. They are essentially monetizing their growing library of intellectual property globally through sophisticated rights management. This creates passive, potentially recurring, high-margin revenue streams that help stabilize the entire financial picture.
Okay, so the theory sounds great. Did we see concrete evidence in Q3 2567 that this international appetite for their content is real and that this high-efficiency model is actually working in practice?
Yes, the sources highlighted a really crucial milestone achievement in Q3 related to the series Thong Prakai Sang.
That was one of the hits you mentioned earlier.
Right. This drama successfully sold its broadcasting rights to a major Japanese company. Now, the significance of this really can't be overstated.
Why? What's so special about selling a show to Japan?
Because the report specifically noted that this was the first non-boy love or girl love series from ONEE to achieve this level of market penetration in Japan.
Okay, unpack that. Why is the non-boy love, girl love distinction so important for their broader international strategy? What are boy love and girl love dramas?
So boy love, often abbreviated as BL, and girl love, GL dramas, are genres that focus on romantic relationships between male characters, BL, or female characters, GL. These genres have developed really significant, passionate niche audiences globally, particularly across Asia, often driven by very intense online fandoms.
Okay, so they have a built-in global audience already.
Exactly. Which often makes them, relatively speaking, easier to license internationally initially, because there's a known, dedicated audience waiting for them. Securing a major deal in a key market like Japan for a mainstream drama like Fong Prakaisang, that proves something different.
What does it prove?
It proves that ONEE's content quality, their production values, and their universal storytelling capabilities extend beyond just those niche genres. It shows their mainstream dramas have broad international appeal too. This potentially opens up massive new, broader markets for their entire catalog and validates their appeal to traditional broadcasters and mainstream platforms worldwide, not just niche streaming services.
That's a really significant step then. And they're not just selling to Japan, right? They seem to be using all the major global players to distribute their content library.
Absolutely. They're turning themselves into a high-volume regional content supplier. Their shows are finding homes on pretty much all the key global OTT partners. The sources specifically mention deals or content placement with giants like Netflix, Disney+, Hotstar, Amazon Prime Video, View, and IQIYI.
They're playing the field.
They are. And importantly, they're securing long-term deals in some cases. For example, the source noted that another title, Angkarn Klumpong, Extreme, which is interesting because it's based on a popular radio show, showing they can monetize ancillary IP too. Sold long-term rights to a major global OTT platform.
And long-term rights deals. That's the holy grail, isn't it? That's the definition of stable, recurring, passive revenue streams that you were talking about.
Exactly. This is all about building that strategic protective moat around their valuable content library. Which brings us perfectly into Section 4, digging into how efficiently they're actually managing the underlying costs of running this increasingly complex, multifaceted global operation.
Right. Because generating revenue is great, but if your costs are running out of control, it doesn't help the bottom line. Efficiency is key, especially when the revenue mix is shifting and the macro environment is volatile. Let's start with the cost of sales and production.
Okay. And we did see some definite efficiency gains here in Q3, which directly contributed to that strong gross profit margin performance we discussed earlier.
What did the numbers show?
The cost of sales and services ratio, basically. What percentage of revenue is eaten up by the direct costs of producing content and services, it improved. It came down to 58.09% in Q3 2567.
And how does that compare?
That was a clear reduction from both the previous quarter, Q2, and the same quarter last year, Q3 2566. So it indicates they are getting better control over their core content production costs.
What drove that improvement? Just tighter budgets?
The report cited two primary drivers: improved management of the actual content production costs themselves, and also greater efficiency in managing the costs associated with artist management within the idol segment. So yes, it looks like cost discipline is improving. They seem to be getting better at producing their hit shows more cost effectively.
And that efficiency is crucial, right? Because it increases the margin on both the domestic ad sales and makes that international licensing revenue even more profitable.
Absolutely. Lower production cost base means higher profit per licensed show.
Okay, now let's talk about a really interesting strategic pivot within the production business segment itself. Because somewhat ironically, the revenue for that specific segment actually declined year over year and also for the first 9 months of the year. For listeners, why would a reduction in revenue in their production services segment actually be framed as a potentially positive strategic choice by the company?
Yeah, this is a classic example of potentially trading lower quality, maybe short-term revenue for higher quality, long-term asset value. It's about priorities.
Explain that. What's in the production business segment?
Okay, so that segment includes two main things. Production services, which is essentially one acting as a hired gun, a contractor, producing content for external clients.
Like another TV channel or a streaming platform?
Exactly. And the second part is studio rental, renting out their physical studio spaces. Now, the revenue from the production services part declined. Why? Because the company made a very deliberate, very strategic decision to prioritize creating their own in-house original content.
Ah, okay. So they're consciously choosing to do less of the low-margin contract work they do for other companies.
That seems to be the strategy. Look, taking on that external contract production work, it provides guaranteed immediate revenue, which can look good in the short term. But it often comes with lower margins, and maybe more importantly, the client usually owns the intellectual property, IP, that gets created.
Right. ONEE doesn't own the show they just produced for someone else.
Exactly. By focusing their resources, their creative teams, their production facilities inward on their own original content, they create high-value assets that they control the IP for. So while this might decrease that short-term service revenue line, it vastly increases the long-term potential for revenue extension through all the things we've discussed. International licensing, driving the idle marketing engine, merchandising, platform engagement.
They're shifting from being just a production service vendor to being primarily an IP asset owner.
That's a perfect way to put it. It's a strategic shift in focus towards higher value activities.
Okay, that makes complete sense then. And the only part of that production division that actually grew was the studio rental side.
Yes, that's right. Studio rental revenue was actually up quite strongly, 46.14% year over year in Q3 2567.
So what does that tell us?
It tells us that the external demand for their physical, world-class production facilities, like their Big Axe studio complex, remains extremely high. It's being utilized not just by domestic Thai productions, but apparently by external global film crews coming in as well. So they're still monetizing their physical assets very efficiently, even while they strategically prioritize IP ownership for their own creative output.
Okay, good balance there. Now let's move on to the operational overheads, the selling, general, and administrative expenses, or SG&A. Here, the picture looked a bit more mixed, didn't it? We saw conflicting trends. Selling expenses went down, which seems good, but administrative expenses went up quite significantly.
That's right. The decrease in selling expenses is actually a really interesting data point, and it links back directly to the success of their digital strategy we talked about earlier.
How so?
Well, the costs related to sales and services decreased quite nicely, down 7.15% quarter on quarter, and down 14.24% year over year in Q3. Management specifically attributed this to more efficient control of their advertising and sales promotion spending.
So they're spending less on marketing.
It seems they're spending smarter. They appear to be successfully leveraging that enormous social media footprint, those 200 million followers, to disseminate information, build hype, and promote their content organically. This reduces their reliance on expensive, paid external advertising campaigns.
Ah, so that's a direct link between building that digital moat with followers and achieving tangible financial efficiency on the cost side. Less need to buy ads if your audience is already listening.
Exactly. It's a significant operating leverage benefit.
Okay, but let's tackle the other side of SG&A. The increase in administrative expenses. Those rose 6.50% quarter on quarter and a pretty chunky 20.59% year over year in Q3. Now, if overall profitability is surging, why are the admin costs rising so fast? We need to unpack the three specific reasons the company cited because I think some of them might be non-recurring, right?
Absolutely. We have to dissect this carefully to understand the normalized or underlying administrative cost base. The reported increase is definitely a mix of things, some strategic investment, some maybe just housekeeping.
Okay, what was the first reason?
First, there was an increase in personnel expenses. This was driven by standard things like salary adjustments, but also importantly, performance-based bonuses.
Bonuses make sense if the company had a blowout quarter.
Exactly. In a creative business like this, you absolutely have to reward successful execution and find ways to retain your top talent, the writers, directors, producers, and key managers making it happen. So, arguably, this portion of the increase is a positive, justifiable investment in human capital, especially given the results.
Okay, that makes sense. What was the second reason? This sounds like the critical one for assessing the true underlying profitability of the quarter. It sounded a bit like financial housekeeping.
It was exactly that. Financial prudence, cleaning things up. The company made a one-time 100% provision for doubtful debt related to two specific trade receivables. One was in the artist management segment, the other in copyrights and licensing.
Okay, what does a 100% provision mean? They basically wrote off those debts entirely.
Effectively, yes. They decided they might not collect on those specific amounts owed to them, so they took the full hit in this quarter's P&L. By taking a 100% provision now, they essentially clean those potentially bad debts off the balance sheet. But the crucial point here is that this provision is a large, non-cash charge, and importantly, it's non-recurring. It's a one-off cleanup.
Right. So if we, as analysts or investors mentally back out this large one-time debt provision, the underlying normal admin cost increase for the quarter would look much less alarming.
Much less alarming, yes. It significantly inflates the reported admin expense growth rate for this specific quarter.
Okay, that's a really important piece of context. So if we discount that big one-time provision, is the remaining underlying admin cost increase still justifiable, given the massive scaling they're doing in areas like idle marketing and global licensing?
I would argue yes, absolutely, because the third factor contributing to the reported increase was higher depreciation and amortization costs.
And where did those come from?
These costs resulted directly from the upgrade of their core enterprise resource planning ERP system, which they implemented earlier in the year.
Ah, okay. So they invested significant capital in a crucial piece of back-office infrastructure, the ERP system, which should improve long-term efficiency, data management, and control. And now that capital expenditure is showing up on the profit and loss statement as depreciation expense over time.
Exactly. So that part of the cost increase isn't runaway operational spending. It's the accounting reflection of a strategic investment they made to support future scale and manage this more complex business efficiently.
Okay, so putting it all together on admin costs, strip out the one-time bad debt provision, and the remaining increase seems largely driven by performance bonuses for a great quarter and depreciation from a necessary tech upgrade. Both seem like strategic positives, or at least justifiable costs, needed for managing this growing regional content provider model effectively.
That's the normalized view, yes.
Yeah.
It looks much more reasonable when you understand the components.
Okay, great. Finally, before we get to valuation, let's just touch on their financial stability. Because managing costs is one thing, but having a strong balance sheet underneath it all is paramount, especially in a cyclical industry. They seem remarkably solid here.
Their liquidity position looks like a tremendous strength, providing a very strong foundation. As of the end of Q3 2567, the company reported having zero interest-bearing debt remaining on its books.
Zero debt? That's impressive.
It really is. Being debt-free means they're completely insulated from rising interest rate hikes, which is a huge plus in the current environment. And it gives them maximum financial flexibility for future moves.
And what about cash?
They also reported a very strong cash position. Total cash, cash equivalents, and some long-term deposits added up to 1,836.87 million Thai baht at the end of the quarter.
That's a pretty big war chest.
It is. That cash hoard gives them significant capacity for future investments in content, potential strategic acquisitions if opportunities arise, or simply the ability to comfortably ride out any future economic downturns without financial stress. It's a very solid footing.
Okay, so we've established the picture. The underlying operational structure looks increasingly sound. It's being driven by a successful strategic pivot towards IP ownership, global licensing, and the idle marketing engine. And it's all supported by improving cost efficiency and robust, debt-free financials. Now, the big question: how is the market translating all this fundamental strength into valuation metrics? Does it look attractive? This brings us to Section 5, valuation and technicals.
Right, and the Q3 earnings report was clearly the catalyst here. It triggered immediate, significant market movement in the share price and also prompted a comprehensive reassessment by analysts covering the stock.
What was the consensus shift among analysts? Did they upgrade?
Yes, the consensus definitely shifted more positively. For instance, the brokerage DAO explicitly upgraded the recommendation to a buy and issued a new higher target price of 3.2 Thai baht per share.
Okay, 3.2 baht. That sounds like a pretty significant jump from where it might have been before. Their previous target was 2.70 baht. What valuation metric were they using to justify that new higher target?
That 3.2 baht target was primarily based on applying a projected price to earnings, or PE, multiple of 16 times to their forecast for earnings. In the forward year specifically, their 2069 Buddhist era projection, which corresponds to 2026.
A PE of 16x. What does that suggest?
It suggests that analysts now have much higher confidence in ONEE's future earning power. They seem to be specifically recognizing the potential for strong, sustainable, low-cost revenue growth driven by this new mix of idle marketing and especially the high-margin IP licensing income. They're clearly expecting strong earnings per share, EPS growth going forward to justify that multiple.
Okay. And the source material also seemed to indicate that right now the stock might actually be undervalued relative to its peers, at least based on its assets.
That's correct. If you look at the price-to-book value ratio, the PBV.
Which compares the share price to the company's net asset value per share.
Exactly. Based on the Q368 book value of 2.93 baht per share, The current price was trading at a PBV of around 0.7 times.
And how does that compare?
That 0.7x figure was noted as being notably below the average PBV for its peer group, which was cited as being around 0.8x.
Okay, so trading at a discount to peers on a book value basis. Why might the market be missing this? If their assets are potentially undervalued compared to similar companies, is there some hidden risk the market is still pricing in that maybe we haven't discussed? Or is it just slow to react?
It's more likely the latter, I suspect. The market often tends to be somewhat backward-looking, right? That 0.7x PBV probably reflects the market's lingering historical view of ONE, seeing it primarily as a traditional, somewhat volatile domestic media stock, rather than fully recognizing its transformation into this high-growth, globalizing content IP owner.
So the low PBV might suggest the market hasn't fully factored in the future growth trajectory implied by these strong Q3 results, especially the long-term value of that content library and the global fan economy they're building.
That's a very plausible interpretation. It could present a potential opportunity for investors who believe this strategic shift is real and sustainable, and that the market will eventually catch up and assign a higher value to those assets.
Okay. Speaking of historical perspective, what about the trailing price-to-earnings ratio, the PE based on the last 12 months of actual earnings?
Right, the TTM-PE. The latest figure provided was 33.05.
33 times earnings. Now, on an absolute basis, that might look kind of expensive to some people.
It could if you just look at that number in isolation. However, you have to remember why that DTM number is relatively high. It reflects the lower, more volatile profits the company generated in the 12 months before this idle marketing boom really took off, and certainly before this massive Q3 profit beat landed.
So it includes weaker quarters from the past.
Exactly. And analysts are explicitly looking past this backward-looking TTM-PE number now. They're focusing on the forward earnings projections. The expectation is that the significant EPS growth they're forecasting will rapidly bring the effective PE ratio down towards that more reasonable 16x level they used for their 2026 target price.
Okay, that makes sense. Let's quickly touch on the dividend yield. It looked quite attractive on the surface, but the sustainability maybe needs some context, particularly given the reported payout ratio.
Yeah, the current dividend yield was reported as being quite high at 7.07%. That's based on an annualized payout of 0.14 baht per share. Definitely attractive in today's market.
Right.
But the accompanying trailing 12-month payout ratio was strikingly high at 121.79%.
Over 100%. So over the last 12 months, they actually paid out more in dividends than they reported in net earnings.
Correct. That's what a payout ratio over 100% means.
Is that a red flag, a warning sign about their cash flow maybe? Or is it more a feature of that earnings volatility we just discussed?
It's much more likely a feature of the volatility and perhaps management's confidence in the recovery. You often see temporarily high payout ratios like this when a company's trying to maintain its regular dividend commitment to shareholders, maybe paying it out of retained earnings accumulated from prior more profitable years, or doing it based on a strong internal expectation of a rapid bounce back in profitability, which of course the Q3 results have now dramatically delivered.
So investors should probably view that 121% payout ratio as more of a temporary snapshot reflecting the recent profit dip and recovery, rather than assuming they can sustainably pay out more than they earn long term.
Exactly.
Yeah.
It reflects the strong profit volatility and the significant cash dividends they paid out earlier in the year based on past performance. For it to be sustainable long term, profits would need to stabilize consistently at this much higher Q3 level, or even grow from here.
Okay, got it. Finally, before we wrap up, let's just look at the immediate market reaction to all this news and maybe the shorter-term technical sentiment for listeners who focus on that.
Well, the fundamental news from Q3 was so unambiguously strong that the market reaction was immediate and quite dramatic. The share price jumped by as much as 20.20% on the day the earnings announcement actually broke. It hit a peak of 2.38 beats during that period.
A 20% jump in a day is huge, purely driven by the earnings surprise.
Pretty much, yeah. A classic positive earnings reaction.
But often, technical indicators can lag, or sometimes they show signs of a short-term correction or profit-taking after such a massive, sharp spike. What did the technical snapshot suggest?
Yeah, the technical snapshot from TradingView, as cited in the sources, showed somewhat conflicting signals, which is important for any investor, especially short-term traders, to note.
Conflicting how?
While the current overall technical reading for the stock, based on its recent price action, remained a technical buy at that moment. The shorter-term indicators, specifically the 1 week and 1 month indicators, were apparently starting to show emerging sell signals.
Okay, so what does that typically mean?
It's a common pattern. It serves as a caution. Despite the phenomenal fundamental news and the initial price surge, the stock might experience some short-term volatility, or perhaps some investors who got in lower might start taking profits following such a massive single-day jump. It just reminds us that technical price action often takes a bit of time and usually requires subsequent quarterly reports confirming the trend to fully align with a major shift in fundamental strength. Short-term noise is normal.
Okay, that's a good perspective. So let's try and synthesize everything we've discussed. We've spent quite a bit of time analyzing how ONEE seems to be successfully navigating what's undeniably a pretty brutal, disrupted media landscape these days.
Yeah, and the Q368 results really stand out as the clearest demonstration yet that their dual-engine strategy combining resilience in the core with explosive growth in new areas is actually working. It's providing both operational stability and significant growth.
Right. We saw the traditional content marketing segment, even though it faced those severe macro headwinds, things like geopolitical uncertainty that really hit traditional ad spending hard. It still showed remarkable resilience and even managed some sequential growth quarter on quarter.
Driven largely by the continued strength of their outstanding content quality and their increasing ability to leverage their huge digital footprint to monetize online.
But the real story, the engine that truly drove that massive profit beat in Q3, was clearly the idle marketing segment.
No question. Growing massively over 66% year over year. This incredibly successful engine built around artist management, global concerts and fan events, and merchandising. It really confirms that strategic shift they've been making, moving away from being just a traditional broadcaster toward becoming a much more diversified content provider and maybe even a broader lifestyle entertainment company.
And underpinning all of that is their core ability to generate that blockbuster content in the first place. Whether it's those high-rating, universally appealing dramas like Mayua and Thongprakai-sang that can travel internationally, or creating and nurturing the popular idol franchises that fuel the fan economy. That ability to create the IP seems to be the core strength, setting them apart from maybe pure traditional media players who are struggling more.
It absolutely is. And the crucial long-term strategic advantage, the real end game here, lies in that high-efficiency international licensing strategy.
Selling the rights globally.
Right. The Q3 performance really proves that content creators can thrive, even thrive significantly, despite all the digital disruption, if they successfully transition into becoming a global licensing and fan engagement business. That move to systematically monetize their content library overseas, selling long-term rights to the big global OTT giants like Netflix, Disney Plus, and others, that's just extremely high margin potential. Why? Because, as we discussed, the main content asset is already created and largely paid for by the domestic market.
It becomes almost pure IP exploitation at that point. They create the valuable asset once, use it to anchor their domestic viewing figures and drive the idol business locally, and then they can sell the international broadcast rights again and again at minimal additional cost. It turns that existing library into potentially a massive, passive, recurring revenue stream.
Exactly. And that is what creates the kind of defensive moat, the sustainable competitive advantage that competitors who are still solely focused on domestic linear TV advertising simply cannot match. Which leads us, I think, to the final, maybe provocative thought for you, the listener or investor, looking forward.
Okay, leave us with something to think about.
The question now is, how quickly will the broader market fully recognize and price in the immense, long-term, low-cost revenue potential that's being generated by this growing, highly efficient content library? That massive back catalog of licensed content, plus the new hits being added, it only requires minimal additional costs to unlock huge global revenues. But the market often tends to underappreciate these kinds of recurring, low-risk, high-margin licensing streams until they show up very clearly and consistently in the profit margins quarter after quarter. So the real question is, when will the market fully value that long-term licensing potential? Because that strategic moat might be what truly defines ONEE's valuation story for the coming years.
So how was that deep dive into ONEE? We certainly covered a lot of ground there. We hope this information gives you, our listeners, a clearer picture of the strategy, the financials, and the potential future direction of this fascinating content empire.
Yeah, it's definitely a company undergoing a significant transformation. If you have any questions about anything we discussed, or perhaps if you'd like us to analyze a specific stock in a future deep dive, please do let us know. We always appreciate listener feedback and suggestions.
Absolutely. Finally, don't forget to follow, like, and share this wherever you're listening. It really helps support our team and allows us to keep bringing you these deep dives. Thank you.